Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, April 25th, 2023. It is 10:54 a.m. Eastern Time as I'm starting the video, and I'll start out here with an update on the markets. We're just, of course, still in that trading range, but flirting with the bottom of that support zone. Really, where we were yesterday, just about maybe a hair lower. So I'm going to go over a quick update on the markets and reiterate that this week is weak one way or other. Volatility is going to expand. The market's going to move. Could be up, down, back, forth. Could be straight up, straight down. But this period of extremely low volatility in this trading range I've been highlighting for weeks now. One of the most obvious trading ranges in a long time. Perfect little box there in QQQ. That is likely this week to break one way or another, and that's because, of course, again, we have tonight after the market closes, Microsoft and Alphabet both reporting. Tomorrow morning, tomorrow after the close as well is Meta. Then on Thursday, I want to do just point out that CAT, which is still a swing short trade, that's an active trade. I'll get to that in a second. They report on Thursday morning before the market opens. So just know that anytime you hold a stock in earnings, or in this case, if you hold QQQ even, which is it's not really a diversified ETF or index. You'd think because there's 100 companies, but again, it's not only the concentration of those market leaders, the big fangs, Apple, Microsoft, Alphabet, Meta, Nvidia, and Tesla being the top holdings that make up over half of the entire Nasdaq 100. So you had that, first of all, which makes it a very, less diversified when you count the weighting. Diversification in theory, but not in mathematical weighting. And then more so is the correlation. Don't forget that Tesla and Apple have nothing to do with each other. But if or let's just use Microsoft and Apple or Alphabet. But if one of them has a big move after earnings, the others probably usually follow, and that's just the algos firing off. If they're buying Apple or selling Microsoft or buying Microsoft, it usually spills over. So, and I just want to point that out. So if you are somewhat risk averse, if you're completely risk averse, you're doing the wrong thing. Put your money in CDs, whatever. But if you're, obviously, if you're listening to my voice, you like to trade, you like to invest, whether you're a swing trader, investor, active trader, day trader, just know that, with these big market moving stocks, the market leaders reporting this week, we're going to see that volatility. And I'll give you I've been giving you my thoughts of which way I think it's going to break, and we'll see. I'll be proven right or wrong soon. And the big earnings hump is over. This is hump week right now. I always call it that. And then it really concludes next week with Apple reporting on Thursday after the market closed. But again, you're going to have almost all of them reporting this week. That's it. So here we are. We are at the bottom of that support zone. Remember, it runs from about 313-ish down to 312. And this is a 60-minute chart. 312 is a level on the daily. But you can see the bottom of that level. Boom, boom, boom. And there we are right there at the bottom. And I still favor a downside resolution, even if, and I just want to say, even if there's a knee-jerk up reaction. And I say this every time there's a big earnings report or a big FOMC meeting. Remember, the initial reaction quite often, not always, but quite often, is not the reaction that sticks. Time and time again, I've seen one of these stocks blow the cover off the ball, rally hard in the after hours session, because that's when the big tech, all the big fangs always report after the close, only to see that those gains either reverse by the open the next morning, or maybe they followed through, popped, gapped up the next day, and then sold off. Now, that doesn't guarantee if it goes up after hours, after earnings, that it's not going to continue to go up. I just wanted to say that try not to read too much into the initial reaction, even if it's a high single digit or even a double digit move in some of these stocks. All right, just want to throw that out there. And then remember that, Microsoft and Alphabet, big weighting right there in the Nasdaq and S&P, but then you have Meta, a little less, but Meta is one of my favorite shorts for the big fangs right now. I'll get to that in a second. And then, of course, Amazon on Thursday there. All right, so that's that. No change there. We're right there at support. It's been, a pretty consistent pattern of, sell the top of the range, buy the bottom of the range, or it's just a little ping pong there. And again, it's the divergence here on the 60-minute chart. You have divergence on the even more significant daily time frame, which we're not looking at right now, and the even more significant weekly time frame. So you have a lot of, to me, the technicals point to, regardless any near-term pop or even a near-term upside break of the trading range, the technicals to me still point to considerable downside. And again, my targets on the Nasdaq 100 remain anywhere from 20 to 30% lower. So I'm not looking for a little correction on a break of this. I'm, positioned, have been, and will add significantly, substantially to those positions if and when we start to break down and trigger those next sell signals for swing trend positions that could last for weeks or even months. And likewise, if things go the other way and my read on the charts is wrong, then at some point soon, probably be towards the end of this week or even next week, I can just tell you right now, at that point I will look to start scaling out and closing out the positions that I already have, the short positions on the tech and the Nasdaq. So that's it. Let's wait and see. And there it is at support, right at the bottom of the support zone now. Here, I'll zoom in for you. You can see the divergences are still intact, and that's that. Let's look at who reports tonight, which is Microsoft and Alphabet. 60-minute chart, divergent high, big divergence, negative divergence there. We've been diverging on the RSI all this time. When you see big divergence like this on a 60-minute chart that really started back here on the RSI and right here in the PPO, you go out into the daily and you can see it there. So this is what Microsoft looks like on the daily chart. There's your big divergence right there on both the PPO, RSI. This is, to me, again, it's not to me. This is the clearest and largest negative divergence that we had since the end of the last super bull market, when Microsoft peaked back here in around, looks like November, had comparable divergences at that point in time. So we haven't seen anything like that. The only other divergent high that I picked up on since the bear market started was back here. It was a much smaller divergent high, and that was still, ended that bear market rally and was followed by about a 17% drop right there. There's our recent trading range of Microsoft. So Microsoft already broke down. If there wasn't earnings, or if earnings were out of the way, I would say that's an all-in moment. A pure clean sell signal, the break of both the uptrend line there, and then you went into that trading range, just like QQQ is in now, and you had a definitive downside break yesterday with follow through today below the 283 was the bottom of that range. However, I always say this, breakouts that occur, whether it's a downside breakout or breakdown or an upside bullish breakout, those that occur right before stock reports earnings, you always have an increased risk that it could prove to be a false breakdown. Again, the charts indicate to me that the next tradable trend in Microsoft is down, regardless if they do this after earnings, put in a marginal new high and then reverse, or if they just gap and crap tomorrow, gap down and run. I just wanted to say that, again, when the charts are clearly bullish or bearish heading into earnings, that's usually the way the stock will go. That is usually the next trend after. And this was a clearly, to me, was and still is a clearly bearish technical posture on Microsoft. Okay, and the other big FAANG to report tomorrow is Alphabet. You have GOG or GOGL, Class A, you can either one. And same thing, negative divergence right there. Biggest divergence since that was really where it peaked right there. That divergence continued on like this. That's really where the divergence line should be drawn. So, and I always say this, divergence is not a sell signal, it's a condition, an indication that a trend change is likely, and you had divergence there. And it's not as if it didn't play out. There was a shot across the bow, the initial drop there, you had divergent high there, you dropped even further. Bigger divergence typically leads to a bigger drop, and then yet marginal new equal or marginal new high, even bigger yet, and that's the one that finally did the trick. Again, they were swing tradable pullbacks. You could have positioned short on that trend line break there, as that trend line break there. Those were two sell signals, and then finally Alphabet gave up the ghost there, and fell from that last and final divergent high 45%. And so, I know the case can be made, and a lot of bulls are making the case that the bear market's over. It's market leading huge, tech stocks dropped, 50% or more, or give or take. And that's all. Again, the read on my read on the charts is that this is still just that was an initial leg down, a bear market with more downside to come, and time will prove me right or wrong. But again, I've been making a pretty strong case for a while that we're likely going much lower, and it's going to be a much longer bear market than any in recent history, really going back on nearly 5 decades. And so that's what I'm still working off of, my primary views on the market. So that's it. We'll see where they go. And again, the takeaway here is that they report tonight, and based on the divergence and everything else, that whether we have an initial pop or drop, I think in the coming weeks to months, Alphabet will come down here, probably check that uptrend line, and ultimately, and then I turn my focus. Really, the weekly chart helps shape longer term outlook. There's a very, very significant long-term primary bull market uptrend line off the late 2008 lows in Alphabet, and it's precariously close to that now. So the bull case would say, you buy pullbacks to a primary uptrend line, and that's what happened. But this is weak. Usually when you check a long-term uptrend line, it's one and done. You get a nice correction down to that trend line. This time we've been hugging it, just hitting it. And if it cracks, then that's going to, and we'll see comparable trend lines on other market-leading stocks. When those start to go, what I call there's still many of the market leaders, and by some metrics, the indexes themselves, the S&P 500, Nasdaq 100, are still at or above some of my long-term bull market uptrend lines. So from, call it what you want. I know obviously, this is considered a bear market. I call it that. But then if you look at it from a longer-term perspective, you can say it's a correction in an ongoing super bull market. And so point being, when these trend lines, if and when they go, and it's more of a collective thing, and it's always, it's not binary where it's just one breakdown of one stock or one index. When you start to see the S&P and the Nasdaq 100 and the Wilshire 5000 and in Alphabet and Microsoft all start to break their longest long-term uptrend lines, that tells you that we're really in probably early stage bear market, something more comparable to Japan's lost decade. Google that one, see what they did. It's really 2 decades of negative returns in the Nikkei and their stock market, and they had very comparable fundamentals back then, leading up to it, a big real estate and credit bubble, and then zero interest rate policies, similar response, and so the fundamental case can be made too. And again, that's fundamentals. This is technical, so we'll watch these levels. And even to check the line again, I just want to say this: the Alphabet would have to drop. It's at 105. It's right at that. This is a really good resistance, by the way. That was resistance there. Had a little consolidation, popped it on a breakout candle, and then it was support during the bear market there, and a period of consolidation that broke to the downside. That set the next trend, and we've rallied back and been checked on that level. So this is why there's so much lining up right now, not just Alphabet, but the indexes themselves, a lot of the market leading stocks back to major, there's QQQ, major resistance levels. So to me, it's an important make or break moment here. Again, it may be a week or so before we see a definitive resolution of this range, these resistance levels that we're back testing, meaning a clear rejection or a clear breakout. And a clear breakout then takes us up to the next, or increases the odds that we're going to go up to the next big resistance levels. And there might be a long side trade to be made, and I'll let you know if I change my mind on where we're going. But that's as of now, I'm favoring the downside. All right, so back to that GOGL at resistance right there. Microsoft on the weekly, Microsoft. And drew this out, I guess, in one of the videos recently. This is the path that I had right here a few weeks ago, 3 weeks ago. And we've started to come down 2 red candles since, but I have us going down to my next target here, T2. At that point, if and when Microsoft gets there, which by the way is from where we're at right now, that would be a drop of about 30% on Microsoft. So give or take, QQQ should fall about 30% or so if that pans out. At which point, if QQQ and Apple and Microsoft are all coming up on support levels, that's where I'll be, closing out swing and trend short positions and looking to go long for the next bear market rally, and then recycling back out of those, or closing those out and then going back short, and ultimately swinging down to these long term. You can see Microsoft. There's your secular bull market uptrend line of Microsoft. And it's just been my experience in securities like this this is a multi-decade trend, that every now and then you're going to come back and visit that trend line. And we got so far ahead of it with so much fiscal monetary stimulus by the Fed and federal government in big tech, of course, being every overcrowded, overloved trade, that I put very good odds that within the next year or so we're going to come back and at minimum check that. And just so you know, if you think of me as a perma doom and gloom bear, because that's calling for a drop from the highs of in one of the world's largest companies, that's again, if and when hit, I'm taking the top right there and I'm projecting in time, it might be somewhere in here, that's about a 60% drop. And yet all that would be wipe out a lot of people that have tried to held on and bought into that whole it's time in the market, not market timing, sit and hold on to your things. 60% drop would do a lot of damage to a lot of hedge funds, a lot of pension funds, and of course individual investors. But where I'm going with that is, hey, all that would be, if we get that, is just a check of a long-term bull uptrend line, and it could keep the longer term uptrend on Microsoft going. So again, if and when we get there, and that's going to be my third target, T2 is next, but I'm getting ahead of myself. Just to get down to T2, again, we need to fall about 30%. And things change, I'll let you know. You can see if we get there, we'll have divergence the way I've drawn it out here. But anyway, so that's my outlook on those, and I just want to focus on those two because they are reporting tonight, and then we have Meta coming up tomorrow after the close. Here's my chart on Meta. One of, in my opinion, one of the best looking of short, if you want to short individual stocks on the market leaders. Again, you can just sit there. Meta's not the weighting it used to be. Last time I checked on April 10th, it was only about 4% of the Nasdaq 100, which is still a significant weighting, but you just have a major bear market downtrend line just above. So if it pops after earnings, you've got that price resistance, just a lot of limited upside in my opinion. At least until significant resistance. But you also recently triggered a sell signal on a break of the very steep and overextended uptrend line right there off the November lows. Big divergence again. This is a common theme, and I know I sound like a broken record, but the charts are really lined up for it. It's not just one stock or one index. It's a lot of this is telling me the same thing. And we already had a breakdown, as I mentioned about a week ago. We had a sell signal triggered, and it's been moving lower. Nothing big, but about a 3.5% drop. And again, this is likely to be, whether we initially pop and then drop or just drop, the start of the next leg down in a bear market. There it is on the weekly. You can see the same primary bear market downtrend line where we're at right now. I can tweak it up like that and come in. You can see captures all these candles there. Same one I had on the daily, and there's the if you look at it, if you're trading a longer term perspective, if you use the weekly charts, you're less prone to taking a long or a short entry that proves to be a false breakout, aka a whipsaw signal. In other words, if you're trading a long-term trend trader, a long-term swing trader, you want to see a weekly close below this trend line. And being that today is only Tuesday and they report tomorrow, this candle is going to change. You're either going to see it at the end of the week, bigger red candle to confirm on Friday at 4 p.m. If you have a solid close below that trend line, that is a confirmed sell signal on the weekly. Or remember, this candle's still developing and it could close green. This is just an intra-week break, only to close back above the trend line. So So those are the things I'll be watching for this week. And you can see the PPO, very high level stretch, RSI oversold. So if you look at the indicators, which I'll expand here and throw up the histogram on here, you can see what you want to look for: bearish crossovers. We had a bearish crossover right there, and that was a double-digit drop easily right there. We had a bearish crossover there right at the end of the great bull market. In the beginning of that, what is that, it meta drop, what was it, 75, 76, almost 80%. And again, simple stuff. So I don't use any one of these by themselves, but each of these, you look at that as a sell signal. The bearish PPO crossover, you look at it there, and then you didn't really profit much on a trend short, but you also sidestepped. There was some downside, but it was a sideways market, so it ended the uptrend. And so had you shorted or got out of your longs, you would have been happy to get out of your longs and deploy that money elsewhere, or short and maybe didn't make anything then, but you certainly would have on that one. So do the odds: 1, 2, 3, 4, and if you go back here, 5 bearish crossovers in the last several years, and most of them panned out for well into the double digits drop. So what I'm getting at, we didn't have it yet, but watch for that. PPO's turned down. The slope is now negative. It's starting to roll over, and a cross looks likely and imminent from this point in time. Imminent on a weekly chart, well, each little bar is a week, so imminent doesn't mean tomorrow or 3 minutes from now. It means likely within the next few weeks. And sometimes these big green hills, when you get very extended, that the trend can be pretty powerful and turn pretty quick when you see a rush for the exits out of a stock like that. So okay, all right, we're last two for earnings. We have Caterpillar Thursday morning. Caterpillar, we shorted somewhere in here. We hit my first target there, a little bounce off T1. It's expected, it's normal. Hit T2 there. The reaction was more in time, went down, hit T3. We bounced back to T2, and we've been holding on T3. So we're wedged. We have a trading range similar to QQQ, bouncing between T2, which was it was support on the way down. Support, once broken, becomes resistance. So that's what it's been doing, popping back and forth. And so the next sell signal, objective shorts come either on a bounce back to resistance, which you had there, or the next break of support, which is T2, about 211 or so. Call it now. You have that little low below there. If you want to be safe, you can wait for break of 209, but that's still T4, and then T5 is all the way down here, 162. So if my fifth and final targets hit, then there's still another 27% downside for CAT, and we should have a better idea come Wednesday which way the stock wants to go from there. I did note there was a little divergent low here, but you got to be careful about bullish setups, bullish divergences, things like that. In a larger bear market, they tend to either not play out or play out for a very small bounce, and so far that's what that was. All right, so Intel also on I think Thursday as well. Intel doesn't have the weighting it used to in the big semiconductor sector, but there was that basing pattern there. We had the breakout, hit that 33-32 target, and stopped cold there, and it fell back into. So the breakout has now, this breakout of that basing pattern has clearly failed, and that is bearish for Intel. So we were able to game, or at least I was, a good part of that bounce, that initial bounce off that bottom big divergent low. But there's an example of big bullish divergence, breakout, and so far a breakout that's failed. So that was a big old bull trap. If the stock can get back up and then take that out, and then your next target's still that downtrend line. But the fact that the breakouts failed increases the odds this one's going to go down and probably break that downside range, which was also very big support on the weekly chart. Let me put that PPO histogram back over here. Really good support there. And let me cover a few more things, and we'll change gears here. The VIX still looks ready to have a big move here. You have, this is a daily chart right here. These purple lines show you right here. We had recently divergence. I'm trying to use my line tool here. There we go. We had a divergent low right there, and we had a big move up in the VIX. The VIX rallied from that divergent low about 80%, and went on to make a marginal new low from that previous divergent low right here. The divergence has only grown larger, and we have a PPO pending. It's about to cross over on any more upside. So you can see right here, that would confirm this divergence. If the PPO, you get the histogram crosses green, that's a bullish crossover like you had right there, and then you had that big pop coincide with the breakout of that trend line. You can see the downtrend line right there. So everything's set. Like I said, this is the technicals are really set up for a nice correction. The bulls can foil it. If the bear market's over, then that's what happens. That bearish setups often don't materialize in a bull market. So if those that are saying the bear market's over and we're in a new bull, if they're right, then this gets foiled. This breakout, you can see the VIX already broke out of the trend line. The divergence is about to be confirmed on any more upside. So depending how these market leaders go, of course the VIX will most likely explode if I am correct, and the Nasdaq 100 breaks down below that trading range, and these stocks, these big market leaders get sold after earnings. If they get sold hard and the technicals play out, yeah, the VIX is probably going to shoot up and do well over 80% on the next leg down. My longer term targets would take us way past this level here, that 3760. And that would be a move, just to get up to that 3760-ish level. That's 130% return on the VIX. Obviously, you can't buy the VIX directly. You can buy futures on the VIX, options on those VIX futures, or you can use the VIX ETNs. Be careful, ETNs carry additional risks that ETFs do not have. An ETN is exchange traded note. Those are just pretty much IOUs from the banks that issue them, like Credit Suisse and others. Of all of them, probably the VIX ones have the highest risk. I've seen more than one a few years back. At least 2, if not 3, of the VIX ETN blew up. What happened is the VIX exploded, and then all of a sudden those ETFs stopped going up, or they weren't going up as much as they should have been, with the VIX exploding higher. And again, this was back a few years back. And then what happens is they busted. They weren't set up with the derivatives that they were using to attract such a large and fast move in the VIX. And that's the nature of the VIX. When it wants to run, it can really run. And so what happened is those investors in the VIX ETN, instead of making 100% or more on their money, they lost everything, because those ETNs, they were delisted by the issuers. So anyway, I want to throw that out there, that hey, there's a lot of meat on a VIX trade if you get it at the right time, and your timing has to be superb, because the VIX will typically fall over time, and it has these brief spikes up that coincide with legs down in a bear market or even corrections in a bull market. And so the easiest way to trade it, align your entries and exits or your positioning with the charts of the indexes. VIX is going to track the S&P a little bit better than the Nasdaq, but the Nasdaq is really going to determine where the stock market goes. It's just a higher concentration of those market leaders, and there's that 312 level. And so if you see QQQ break down and start taking another leg down, VIX will fly higher. And again, you're probably better off, in my opinion. I like to trade VIX futures, that's me, but you can use the VIX ETNs like VXX if you don't have another option. Just don't put too much in them. They're high risk. The VIX is, trading the VIX is. So alrighty, a couple more and we'll wrap it up here. I gave you Treasury bonds about 2 weeks ago. It was a short trade. Then the last update I did was on Wednesday of last week, so almost a week ago today, and told you I covered that. I had taken that short for both a hedge and it panned out. Let me get to the chart here. And then expected a bounce here, if I can find the chart for you. ZB. Yep, right here. So we were right here. That was my pullback target. It was support 129 right there. We had a massive resistance up here, and a lot of pullback trades, especially with the divergence. So that one panned out, and then as I said, we had a bullish falling wedge, and broke out. And I told you I didn't have a very strong opinion on how high that could carry. I said at least to this level we got that, but that that divergence and the bullish wedge has played out. Hit that first target, pulled back, moving up now. And this is also telling me that the institutions are the smart money. Remember, how many cocktail parties you've been to and people are talking about trading Treasury bonds? No, everyone wants to talk about Apple and Bitcoin and all that stuff. pros trade treasuries. This is institutions, pension funds, hedge funds. They will move into treasuries as a flight to safety, either in anticipation of or during periods of market turmoil, corrections and downdrafts. And they've clearly been buying treasury bonds lately, even though the VIX, and I think that's what's probably throwing some people. The VIX has been just non-responsive lately, coming back down. But again, I just showed you the VIX is poised to explode based on the technicals. Big divergences. Again, bigger divergences than that last 60 whatever percent run. And so treasuries, I'm out. I had no position. I took profits right here covered there, and then went long for the quick bounce and the breakout and support. And just I have no position and no strong convictions on where it goes. All I can tell you is there's still big resistance up there, and now that support. So I suspect we'll probably take another leg down based on the scope of these divergences and treasuries. That's my best guess. I don't know if we'll make it up there or not, but if I had to be one way or the other, I'd say short. But it doesn't align with my stock market down post FAAMG earnings theory, because if the stock market takes it hard down in the next few weeks here, if it doesn't like what the FAAMGs are selling come earnings, then you might see that flight to safety in treasuries. So I'm just standing aside. I just want to do an update for those that took either the short, down off the highs, or the bounce trade. Trail your stops up if you're happy and you think there's more upside. Just periodically ratchet your stops and let it run. All right, so that's ZB. CL I gave you as a bounce trade. Crude oil. Oh, and TLT is the ETF for treasury bonds. I'm just going over the futures right now. CL, remember we put in that divergent high, then I posted as along here. We did that. I said we'd probably come back and back test this primary downtrend line right here, which we did. So then highlight is along there, bounce. We effectively hit T1. Remember these targets, you always want to sell a little bit shy of the actual level. So we hit that yesterday, and it's another test of the trend line. I don't have a strong opinion, but I suspect we'll probably hold support. There's also a big old gap right there, and then maybe continue on up. If we do, remember, this is one I watch even when I'm not trading for the inflation trade, because it's probably the commodity, the sole commodity with the single biggest impact on the CPI. Nothing, increases the cost of living more than oil and gas, gasoline, which is derived from crude oil. So anyways, we'll watch that, and that. So if crude does this, then that keeps the Fed keeps the pressure on for the Fed to be hawkish. If you see energy prices break down and do this, then it gives the Fed a little more wiggle room. So one to watch. And right now, not much of an opinion on where it goes. Just want to give you that update and tell you that it is at both right a hair above gap support. It could go down a little more to hit that, backfill that gap on CL, and it's still back testing that trend line. So again, if I had to guess, I'd probably say another leg up. Cocoa triggered a sell signal today. It's not really doing much. I gave you my level went away. I had a line right here, and it popped that, but it's really not an impulsive breakdown. So whether you want to take it or not, officially it hit the the official entry, so it's an official short trade now, and those are still the targets. T1 right here at about 28.08, and come down, hit that, probably bounce, work our way down to T2, which is the primary uptrend line, and if so, that's going to give you a gain of about 8%. And if you don't trade futures, NIB is your ETN that tracks, and yes, it's an ETN, but commodity, these agricultural ETNs typically don't have the same risk, but again, all ETNs have more risk than an ETF just due to their structure. Little more upside here potentially on the it's roughly a zone. Remember, these ETNs do a pretty good job but not a perfect job, but you want to use the chart of the futures even if you're going to only trade the ETNs, just to see it's more of a pure play on prices. These ETNs they use the futures to track and the price of cocoa or whatever commodity they're trading. So I just wanted to say that this one I still like it as a short trade. Still have by the skin of its teeth really some divergence there, and it's really overextended, and also at resistance right here on the daily chart. So in an active trade now. That's just one I wanted to mention. And then what is? Let's wrap it up with the GDX. Remember GDX hit that fourth target from all the way back here on the breakout. I started, looking for a pullback here, got a little early, and even though that was still a longer term upside target, hit that to the button, then broke the trend line recently, which I highlighted and gave us a sell signal there, and it continues to move lower, but it's at pretty good support, that 33-ish, 33.10 level on the daily right there. About a 6% drop so far, bearish PPO crossover. All I can tell you, it's at support now, so I can say this with conviction. I'm not sure where it goes from here, but I can tell you you're at support. You don't short a stock at support. If anything, you cover a short, or you wait. If you think there's more downside, you wait for the support level to break to short for the next level. Next drop would probably take you down to that 31.50-ish level there. Or if you're a bull, you can buy support around 33 and with a stop somewhat below. So that's it. Again, my convictions aren't super strong, but you're coming off that divergent high on the 60-minute chart as well, and that's pretty good support that we're at right now. Of course, gold and silver, you probably want to know, because we're going to determine where GDX goes. Gold put in GLD, the ETF put in that little island top right there, a little candle separated by gaps on both sides. Negative divergence. It's really been a slow roll in gold, but it has been moving lower. It's down since it put in that doji candle there, about 4%. Silver, same thing, and that one had the bearish engulfing candle right there, engulfed that previous candle. It's been stair-stepping lower. It's more of a support zone right here, right about here, and that's the next support, 2250. And again, it broke the steep uptrend line, and it's already down about. Silver tends to move up and down more than gold, and I'm trying to measure it for you. Already down about almost 6%. Oh, hey, so on the VIX, sorry to loop back to the VIX. Like I said, futures, kind of my preference to trade. There's the VIX, the VIX May futures, May 17th futures. You have this breakout right here, and a lot like the stock market, QQQ particularly, going around this little trading range here, and you can see, so that's resistance. This is where I think the VIX will start to run if it can pop that 2006 resistance right here. Then your next target is a minor support level, a resistance level. So personally, if it pops that level, may or may not get a reaction there. Probably get at least a little reaction, 2070 or 2080-ish. But I think we'll carry up to, that's actually, I'm sorry, that's good support. This is the minor one. 20, that's certainly a first target there, 2080-ish, and that would be a nothing big, but about a 5% pop. Then this is minor resistance there, about 2150. And then this is the next target there, about 2373. And to be honest with you, if the market doesn't like what the FAANGs are selling, and when the Qs break down and we start moving down hard, we're just going to blast right on through this and even take out those highs. So there's again the potential for a lot more upside. This is just a 3-month hourly chart showing you that bullish falling wedge right there with the positive divergences. You can see last time we had a little divergent high there, and that sent us down here. So I just wanted to give you those levels. You can set price alerts, but again, I'm going to wrap it up here, and the takeaway is, there's going to be volatility, and there's an increased chance of whipsaws as these market leaders, and it's not just the big tech companies, other industrials and things like that, as they report. But in my view, once Apple takes it home next Thursday after the market closed, that's to me when earnings season's over. It's not officially over, but that's the ones that move the market. They'll all be out of the way. The big semis, everything else. I didn't do an update on the semis, but still very much like that. Last update I gave you, we had taken out the trend line. This one was a short back here. We hit T1 back then, put in a marginal new but divergent high. And it's taken out this uptrend line now, and I still very much like the SOX short trade or the individual semis, and still maintain all 6 targets. T6 is down here if hit, that's going to give us another, from where we're already at, trade's profitable now, but that's still another 15% downside, and there could certainly be more. If QQQ drops 30%, you're going to see SOX drop more. Forever and a day I've maintained this. T2 is down here. These are my weekly targets for SOX from way back before, or right early when the bear market started. You had a sell signal there. We hit my first target. T2 was always this 271 price support, as well as this long-term primary bull market uptrend line. So this is, if you're a trend trader and you're willing to ride out the zigs and the zags, I think this is the end of the bear market rally is over, and the next leg down has just started, and that's going to give you to the trend line about 27-28%, and if we overshoot that and hit that price support at 271, that's about 33%, and that is also right in line with that roughly 30% downside I'm calling for in QQQ. So there it is. Let's wait and see how the market reacts today after the close. Again, don't read too much into it, but we'll follow up from there. Wednesday after the market close, tomorrow after Amazon, Intel, and then of course Apple concluding next week. But by that point, most of the big market leaders will be out of the way, and the market's probably going to pick its direction. I don't think it's going to wait for Apple. It's either going to drag Apple down with the rest of them, or force selling, or maybe we rally. If we rally, either way, I'm going to communicate my thoughts. That's what I do, whether we go down or whether we go up. So, all right, guys, let me wrap it up here. And if anything else stands out, I'll get it out to you. Obviously, to be bearish and short the market is to be bearish and short Bitcoin. Those are official trades too. Bitcoin's coming up on the second target now, getting close. There's also, if you wanted to take profits, if you were, this one's already from the breakdown. I forget exactly where we entered it. I think I entered it before the breakdown, maybe even. I can't remember where. There's a gap right where we are right now, and this one's already down, like, again, roughly 17, 18%, 15% from where we entered. And Ethereum just hit the second target. I meant to cover that earlier. The second target's right here on Ethereum. We shorted that one. I think we nailed the highs on them. Yeah, I shorted them in anticipation of a reversal on the site. And so, wherever it was, it's good for about a 20% drop, and you're at T2 now. So you can take profits there, but if I'm correct, there's a whole lot more downside in this. This is just the initial, I've got, 4 targets right now on Ethereum, which I'll most likely extend if depending on how these big tech stocks report. So, all right, guys, I'm going to wrap it up there. This has been Randy Finney with Right Side of the Chart. Have a great day.